Section 1. The role of artificial intelligence in driving our stock market growth. 1. Brief overview. 1. Exponential growth of AI adoption. The integration of artificial intelligence, AI, across industries, particularly finance, has experienced exponential growth, transitioning from experimental pilots to full-scale business transformations. While projections indicate that by 2025, AI adoption in financial services is expected to reach 85%, such figures are subject to change based on technological advancements and regulatory environments. AI-powered tools are revolutionizing data analysis, forecasting and decision-making processes, enabling companies to navigate complex markets and improve operational efficiency. 2. AI arms race. Among tech giants, major tech companies like Microsoft, Alphabet, and Nvidia are leading the charge in AI innovation. Nvidia's dominance in AI hardware, GPUs, and Alphabet's investments in generative AI models highlight the competitive landscape. This arms race is reshaping market dynamics as firms compete to harness AI for productivity gains and revenue generation. While the competition is intense, it is also accelerating technological advancements and driving innovation across industries. 3. Shift from speculative AI to revenue-generating applications. Generative AI tools like ChatGPT have moved beyond theoretical applications to become integral to business models. These technologies are now driving tangible revenue streams through enhanced customer experiences, personalized recommendations, and automated processes. Hedge funds and financial institutions increasingly use generative AI for tasks like marketing, forecasting, and investment strategy optimization. 2. Importance. Chapter 1. AI as the Fourth Industrial Revolution. Artificial intelligence is widely regarded as a transformative force akin to the industrial revolutions of the past. Its ability to reshape industries through automation, data-driven insights, and innovative solutions positions it as a key driver of economic growth. In finance alone, AI is projected to deliver over $140 billion in annual value by 2025, though these projections should be viewed with caution given the rapid pace of change and evolving regulatory landscapes. 2. Redefining productivity. By automating repetitive tasks and streamlining operations, AI significantly enhances productivity across sectors. Financial institutions report improved customer experiences, 46%, and cost reductions, 36%, due to AI adoption. Though JP Morgan's use of AI for risk management and financial planning exemplifies how companies leverage these technologies for efficiency gains and competitive advantage. 3. AI as a market multiplier. AI acts as a multiplier by driving innovation across industries while simultaneously boosting investor sentiment. Companies integrating AI into their operations often see enhanced valuations due to increased market confidence in their future growth potential. For example, Nvidia's stock performance reflects its pivotal role in the AI ecosystem, with demand for its GPUs fueling market optimism. 3. Current relevance. 1. Recent earnings reports from AI leaders. Companies like Microsoft and Nvidia have reported record-breaking earnings driven by their investments in AI infrastructure and tools. Nvidia's quarterly results underscore its leadership in supplying hardware essential for AI workloads. These earnings not only validate the profitability of AI, but also influence broader market trends. 2. Explosion of generative AI. Generative AI technologies are transforming sectors such as advertising, healthcare, and education. For instance, Alphabet uses generative AI models to optimize ad placements and improve customer engagement. The widespread adoption of these tools demonstrates their potential to create new revenue streams while reshaping traditional business practices. 3. Market reaction to AI advancements. The rise of AI narrative stocks reflects investor enthusiasm for companies leading in this space. Firms integrating generative AI or pioneering new applications often experience substantial stock price increases due to heightened market sentiment. However, this enthusiasm also raises concerns about valuation bubbles and concentrated market returns. 4. Speed of change and high cost of entry. The speed of change in the AI sector makes predictions and valuations particularly challenging. Rapid advancements can quickly alter market dynamics, making it difficult to assess long-term impacts. And additionally, the high cost of AI development and implementation creates barriers to entry, influencing market concentration and favoring established players with significant resources. Section 2. The rise of AI technologies in the stock market. 1. AI applications, machine learning. 1. Natural language processing, NLP, for sentiment analysis. NLP algorithms analyze unstructured data from diverse sources, news articles, earnings calls, and social media to gauge market sentiment. Tools such as AlphaSense parse financial documents and earnings transcripts, identifying bullish or bearish signals that enable traders to anticipate market movements. However, NLP faces challenges in interpreting sarcasm and contextually ambiguous language, potentially leading to misinterpretations. Moreover, the risk of sentiment manipulation through coordinated social media campaigns, e.g. Reddit's Wall Street bets, poses significant ethical and reliability concerns. 1. Reinforcement learning for algorithmic trading. Reinforcement learning, RL, optimizes trading strategies by iteratively learning from market feedback. Hedge funds, including ADIA and Binatix, utilize RL to adapt to volatile market conditions, enhancing risk-adjusted returns. Key risks include over-optimization to historical data and model drift, where strategies falter in live markets due to evolving conditions. The inherent lack of transparency in RL models also raises ethical questions regarding accountability in trading decisions. B. Predictive analytics. 1. Nonlinear pattern recognition. AI models can identify intricate relationships in financial data, such as volatility clustering and momentum shifts, through techniques like LSTM networks. These models generally outperform traditional statistical methods in forecasting market trends. However, the black box nature of these AI systems limits transparency in decision-making processes, making it difficult to ascertain the rationale behind specific predictions. 1. Alternative data sets. Alternative data sets provide real-time insights from unconventional sources, including satellite imagery, credit card transactions, and social media activity. For example, Foursquare's utilization of foot traffic data to forecast Chipotle's earnings decline demonstrates the potential of such data. However, this data can be noisy or biased, necessitating rigorous validation to avoid flawed predictions. Moreover, ethical concerns about privacy and fairness arise, particularly concerning the use of consumer behavior data. C. Automated trading. 1. High-frequency trading, HFT. AI-driven HFT systems execute trades in milliseconds, capitalizing on microprice inefficiencies. While HFT enhances market liquidity, it also carries the risk of triggering flash crashes, as exemplified by the 2010 flash crash. Firms like Renaissance Technologies rely on sophisticated AI systems to balance execution speed with robust risk controls. 1. Robo-advisors. Platforms such as Betterment and Wealthfront employ AI to automate portfolio management for retail investors, delivering low-cost, personalized investment strategies. While adoption has surged due to their accessibility, critics caution against over-reliance on algorithmic recommendations, especially during periods of significant market volatility. 2. Stock market APIs and data access real-time. Data importance. AI systems critically depend on real-time data feeds from APIs like AlphaSense and Trade Ideas to execute timely trades. Even millisecond delays can significantly erode profit margins, especially in high-frequency trading environments. Challenges. 1. Data quality. Noise, incompleteness, or bias in datasets, e.g. social media sentiment, can skew predictions. Coordinated pump-and-dump schemes, such as those observed on Reddit's Wall Street bets, have demonstrated the potential for manipulating AI-driven sentiment models. 1. Latency. Cloud-based solutions like AWS and Azure have substantially reduced latency. However, infrastructure costs remain a barrier for smaller firms seeking to deploy advanced AI trading systems. 1. Security. Cyber attacks targeting AI systems, including adversarial attacks that poison training data, pose significant systemic risks to financial markets. Cloud-based solutions. Platforms like AWS and Azure facilitate scalable AI deployments, enabling firms to process vast amounts of data for predictive analytics. However, Reliance on third-party cloud services raises concerns about data sovereignty, particularly in light of increasing regulatory pressure. For example, the EU's GDPR mandates stringent data localization requirements, while the US SEC emphasizes robust data protection in financial systems. Section 4. Sectoral influence, AI across industries. 1. Technology. 1. Specialized AI chips and semiconductor stocks. Specialized AI chips, such as application-specific integrated circuits, ASICs, and tensor processing units, TPUs, are transforming the semiconductor industry by enabling high-performance workloads for deep learning, generative AI models, and autonomous systems. Nvidia's GPUs dominate this sector, driving a 126% year-over-year revenue increase in fiscal year 2024. Competitors like AMD and Intel, along with hyperscalers such as Google, TPUs, and Amazon, Inferentia, are intensifying market pressure. Smaller chip makers face barriers due to high development costs and limited access to advanced manufacturing facilities. Ethical concerns also arise regarding environmental sustainability as AI chip production consumes significant energy resources. 1. AI platforms as a service, PaaS. Platforms such as Microsoft Azure's OpenAI services and Google Cloud's Vertex AI enable businesses to integrate advanced AI capabilities without building infrastructure from scratch. These PaaS offerings generate recurring revenues through subscription models, contributing to significant growth in cloud services, e.g. Microsoft reported a 35% increase in Azure revenues in 2024. However, reliance on cloud-based PaaS solutions increases vulnerability to cyber attacks, including data breaches targeting sensitive AI workloads. 2. Healthcare. 1. AI in drug discovery, personalized medicine, and medical imaging. AI is accelerating drug discovery timelines by identifying potential molecules more efficiently than traditional methods, e.g. in silico medicine's generative AI. In diagnostics, Zebra Medical Vision utilizes AI-powered tools to analyze medical images with high precision, aiding early detection of diseases such as cancer. Personalized medicine leverages patient genomic data for tailored treatment plans, improving outcomes while reducing costs. Algorithmic bias in diagnostic tools can lead to disparities in patient care, particularly for underrepresented groups. Privacy concerns arise due to the collection of sensitive patient data, necessitating compliance with regulations like HIPAA in the US or GDPR in Europe. Smaller healthcare providers face challenges in adopting costly AI systems. 3. Manufacturing. 1. Smart factories and IoT integration. The integration of AI with the Industrial Internet of Things, IoT, has led to the development of smart factories, which optimize production processes through real-time monitoring and predictive maintenance. Companies such as Siemens use machine learning algorithms to minimize downtime and improve operational efficiency. Small manufacturers often struggle with the high costs of implementing IIoT systems and acquiring skilled labor for AI deployment. 1. Supply chain optimization. AI enhances supply chain management by forecasting demand, optimizing inventory levels, and streamlining logistics operations. For example, Amazon uses machine learning models to ensure faster delivery times while minimizing costs. Increased reliance on interconnected systems exposes supply chains to cyber attacks targeting critical infrastructure. 4. Energy. 1. Renewable energy optimization. Machine learning algorithms optimize wind turbine performance and solar panel placements based on weather patterns and energy demand forecasts. Companies such as NextEra Energy leverage predictive analytics to improve grid stability while maximizing renewable energy output. Google's DeepMind partnership with wind farms resulted in a 20% increase in energy output through predictive modeling. 1. AI in energy trading. Utility companies use AI-driven trading platforms to analyze market trends and optimize strategies for renewable energy assets. Shell has adopted these technologies to maximize returns while balancing supply-demand dynamics on the grid. Compliance with energy trading regulations is critical as governments increasingly scrutinize market manipulation risks posed by automated trading systems. Expanded ethical considerations across all sectors. Ethical challenges include algorithmic bias that exacerbates disparities, e.g. healthcare diagnostics, lack of transparency in decision-making processes, e.g. PaaS platforms, and privacy risks associated with large-scale data collection, e.g. IoT systems. These issues demand robust governance frameworks, emphasizing fairness, accountability, and human oversight. Cybersecurity implications. AI adoption increases vulnerability across industries due to interconnected systems and reliance on cloud-based solutions. Cyber attacks targeting healthcare databases or energy grids could cause widespread disruptions. Strengthening encryption protocols and investing in cybersecurity measures are essential for mitigating these risks. Impact on jobs. AI impacts job markets differently across sectors. 1. Healthcare. Roles such as radiologists face automation risks, but can adapt through training programs focused on human-AI collaboration. 2. Manufacturing. Factory workers may see job displacement due to automation, but benefit from opportunities in managing IoT systems. 3. Energy. Traditional roles in energy trading may shift toward managing AI-driven platforms rather than manual analysis. Governments must invest in reskilling initiatives to address these challenges while enabling equitable workforce transitions. Impact on smaller companies. Small to medium enterprises, SMEs, face unique challenges due to high implementation costs, lack of skilled labor, and limited access to advanced technologies. 1. In healthcare, smaller providers struggle with adopting costly diagnostic tools. 2. In manufacturing, SMEs often lack the resources needed for IoT integration. 3. In energy, smaller utilities may find it difficult to compete with larger firms leveraging advanced trading platforms. Targeted funding programs or partnerships can help SMEs overcome these barriers while fostering innovation at all levels. Section 4. Sectoral influence. AI across industries. 1. Technology, specialized AI chips and semiconductor stocks. 1. Role and impact. Specialized AI chips such as application-specific integrated circuits, ASICs, and tensor processing units, TPUs, are revolutionizing the semiconductor industry by enabling high-performance workloads for deep learning, generative AI models, and autonomous systems. 1. Nvidia's GPUs dominate this space, driving a 126% year-over-year revenue increase in fiscal year 2024. 1. However, competitors like AMD and Intel, along with hyperscalers like Google, TPUs, and Amazon, Inferentia, are intensifying market pressure. 2. Challenges. Smaller chipmakers face barriers due to high development costs and limited access to advanced manufacturing facilities. 2. Additionally, ethical concerns arise regarding environmental sustainability, as AI chip production requires significant energy resources. AI platforms as a service. 1. Monetization potential. Platforms like Microsoft Azure's OpenAI services and Google Cloud's Vertex AI enable businesses to integrate advanced AI capabilities without building infrastructure from scratch. 1. These platforms generate recurring revenues through subscription models, contributing to significant growth in cloud services, e.g., Microsoft reported a 35% increase in Azure revenues in 2024. 2. Cybersecurity risks. The reliance on cloud-based passive solutions increases vulnerability to cyber attacks, including data breaches targeting sensitive AI workloads. 2. Healthcare AI in drug discovery, personalized medicine, and medical imaging. 1. Transformative applications. AI accelerates drug discovery timelines by identifying potential molecules faster than traditional methods, e.g., in silico medicine's generative AI. 1. In diagnostics, Zebra Medical Vision uses AI-powered tools to analyze medical images with high precision, aiding early detection of diseases like cancer. 1. Personalized medicine leverages patient genomic data for tailored treatment plans, improving outcomes while reducing costs. 2. Ethical considerations. Algorithmic bias in diagnostic tools can lead to disparities in patient care, particularly for underrepresented groups. 2. Privacy concerns arise due to the collection of sensitive patient data, necessitating compliance with regulations like HIPAA in the US or GDPR in Europe. 2. Smaller healthcare providers face challenges in adopting costly AI systems. Regulatory landscape. 1. Regulatory frameworks such as GDPR mandate strict data localization and privacy protections for AI-driven healthcare applications. 1. Ethical guidelines emphasize transparency and accountability in decision-making processes to mitigate risks. Impact on jobs. 1. While AI improves efficiency, it raises concerns about job displacement for roles such as radiologists or lab technicians. 1. Training programs are essential to help healthcare professionals adapt to AI-integrated workflows. 3. Manufacturing smart factories and IoT integration. 1. Role of AI. The integration of AI with the Industrial Internet of Things, IoT, has given rise to smart factories that optimize production processes through real-time monitoring and predictive maintenance. 1. Companies like Siemens use machine learning algorithms to reduce downtime and improve operational efficiency. 2. Challenges for smaller firms. Small manufacturers often struggle with the high costs of implementing IoT systems and acquiring skilled labor for AI deployment. Supply chain optimization. 1. Applications. AI enhances supply chain management by forecasting demand, optimizing inventory levels, and streamlining logistics operations. 1. For example, Amazon uses machine learning models to ensure faster delivery times while minimizing costs. 2. Cybersecurity risks. Increased reliance on interconnected systems exposes supply chains to cyber attacks targeting critical infrastructure. 4. Energy. Renewable energy optimization. 1. Applications. Machine learning algorithms optimize wind turbine performance and solar panel placements based on weather patterns and energy demand forecasts. 1. Companies like NextEra Energy leverage predictive analytics to improve grid stability while maximizing renewable energy output. 1. Google's DeepMind partnership with wind farms increased energy output by 20% through predictive modeling. AI in energy trading. 1. Role of AI. Utility companies use AI-driven trading platforms to analyze market trends and optimize strategies for renewable energy assets. 1. Shell has adopted these technologies to maximize returns while balancing supply-demand dynamics on the grid. 2. Regulatory challenges. Compliance with energy trading regulations is critical as governments increasingly scrutinize market manipulation risks posed by automated trading systems. Expanded ethical considerations across all sectors. Ethical challenges include algorithmic bias that exacerbates disparities, e.g., healthcare diagnostics, lack of transparency in decision-making processes, e.g., PaaS platforms, and privacy risks associated with large-scale data collection, e.g., IoT systems. These issues demand robust governance frameworks, emphasizing fairness, accountability, and human oversight. Cybersecurity implications. AI adoption increases vulnerability across industries due to interconnected systems and reliance on cloud-based solutions. Cyber attacks targeting healthcare databases or energy grids could cause widespread disruptions. Strengthening encryption protocols and investing in cybersecurity measures are essential for mitigating these risks. Impact on jobs. AI impacts job markets differently across sectors. 1. Healthcare. Roles such as radiologists face automation risks, but can adapt through training programs focused on human-AI collaboration. 2. Manufacturing. Factory workers may see job displacement due to automation, but benefit from opportunities in managing IoT systems. 3. Energy. Traditional roles in energy trading may shift toward managing AI-driven platforms rather than manual analysis. Governments must invest in reskilling initiatives to address these challenges while enabling equitable workforce transitions. Impact on smaller companies. Small to medium enterprises, SMEs, face unique challenges due to high implementation costs, lack of skilled labor, and limited access to advanced technologies. 1. In healthcare, smaller providers struggle with adopting costly diagnostic tools. 2. In manufacturing, SMEs often lack the resources needed for IoT integration. 3. In energy, smaller utilities may find it difficult to compete with larger firms leveraging advanced trading platforms. Targeted funding programs or partnerships can help SMEs overcome these barriers while fostering innovation at all levels. Final section 4, enhanced version. 1. Technology. Specialized chips like ASICs drive semiconductor growth, plus 126% YOY for Nvidia, while PaaS platforms generate recurring revenues but face cybersecurity risks. 2%. 2. Healthcare. AI transforms drug discovery timelines, e.g. in silico medicine. but raises ethical concerns about bias and privacy compliance under GDPR, HIPAA. 3. Manufacturing smart factories powered by IIoT optimize production processes, but pose challenges for smaller firms due to high costs. 4. Energy. Renewable energy firms leverage predictive analytics, e.g. NextEra Energy, while utility companies adopt trading platforms amid regulatory scrutiny. Section 5. AI-driven investor sentiment. 1. AI and investor behavior. 1. Feedback loops and market volatility. AI-driven trading algorithms can create feedback loops that amplify market volatility. For instance, high-frequency trading, HFT algorithms, which execute trades in milliseconds, often react to the same market signals simultaneously, leading to cascading effects such as flash crashes. During periods of stress, these algorithms may de-risk or shut down, causing sudden liquidity evaporations and exacerbating price swings. Additionally, AI systems that rely on sentiment analysis can misinterpret or overreact to news, social media trends, or macroeconomic indicators, further intensifying market movements. For example, during the GameStop rally in 2021, retail investor sentiment amplified by social media platforms led to extreme price volatility, with AI algorithms exacerbating the trend by reacting to the same signals. 1. Sentiment analysis and trading decisions. AI's ability to analyze vast amounts of unstructured data, such as news articles, social media posts, and earnings call transcripts, enables it to gauge market sentiment in real time. Tools like Kensho and AlphaSense process geopolitical events and economic indicators to predict market disruptions. While sentiment analysis improves decision-making accuracy, it also introduces risks. For instance, biased or incomplete data can lead to flawed predictions, and the reliance on historical patterns may fail during unprecedented events like the COVID-19 pandemic. 2. Bullish sentiment. 1. Rise of narrative stocks and speculative bubbles. AI hype has fueled the rise of narrative stocks, where companies with speculative AI applications attract disproportionate investor interest. For example, stocks like Nvidia and Palantir have seen significant price surges driven by optimism about their AI capabilities, often disconnected from fundamental valuations. This phenomenon is reminiscent of the dot-com bubble, where companies with vague internet-related business models experienced inflated valuations. Similarly, AI-driven speculative bubbles can lead to market distortions and eventual corrections when expectations fail to materialize. 1. FOMO effect and retail investor participation. The fear of missing out, FOMO, has become a significant driver of retail investor participation in AI-related stocks. Platforms like Robinhood and social media forums amplify this effect by making trading accessible and fostering herd behavior. For instance, the surge in retail trading during the GameStop rally was partly driven by FOMO, with retail investors mimicking each other's trades based on social media hype. AI-powered robo-advisors and trading apps further exacerbate this trend by providing personalized investment recommendations that appeal to retail investors' desire for quick gains. However, this behavior often leads to irrational decision-making, as investors chase returns without fully understanding the underlying risks. 3. Regulatory oversight. To mitigate the risks of AI-driven market volatility and speculative bubbles, regulators are exploring several measures. 1. Algorithmic transparency. Requiring firms to disclose the logic and parameters of their AI-driven trading algorithms to ensure accountability. 2. Circuit breakers. Implementing mechanisms to temporarily halt trading during periods of extreme volatility, as seen in the US stock market. 3. Enhanced monitoring. Leveraging AI tools to detect and prevent market manipulation or abusive trading practices in real time. 4. Retail investor safeguards. Introducing educational initiatives and risk disclosures to help retail investors understand the complexities of AI-driven trading. 4. Psychological impact of AI. Investors increasingly trust AI recommendations over human advice due to the perception of objectivity and data-driven insights. This trust can lead to over-reliance on AI systems, even when they produce flawed or biased outputs. For example, retail investors may blindly follow robo-advisor recommendations without considering broader market conditions or their personal risk tolerance. Conclusion: AI-driven investor sentiment is reshaping market dynamics by amplifying volatility, enabling real-time sentiment analysis, and fueling speculative behavior. While these advancements enhance decision-making and market accessibility, they also introduce risks such as feedback loops, biased predictions, and speculative bubbles. Regulators and investors must balance innovation with oversight to ensure sustainable market stability. Section 6. Challenges and risks. 1. Systemic risks. Flash crashes caused by algorithmic trading. 1. AI-powered high-frequency trading, HFT systems, have significantly improved market efficiency and liquidity, but their complexity and speed also introduce systemic risks. 1. Flash crashes, such as the infamous 2010 event where the Dow Jones plunged nearly 1,000 points in minutes, highlight the dangers of synchronized algorithmic trading behaviors. 2. These crashes occur when algorithms react to the same signals simultaneously, creating cascading effects that rapidly destabilize markets. 2. For example, AI systems may trigger fire sales or liquidity withdrawals during periods of stress, amplifying volatility. AI model drift and cyber attacks. 1. AI models are prone to drift, where their performance deteriorates over time due to changing market conditions or outdated training data. 1. This can lead to flawed predictions and poor decision-making during critical moments. 2. Cybersecurity risks are also heightened with AI adoption. 2. Adversarial attacks can manipulate AI systems by feeding them deceptive data, while data poisoning can corrupt training datasets, compromising the integrity of financial models. Complex interactions and tight coupling. 1. The interconnected nature of algorithmic trading systems creates a tightly coupled market ecology. 1. Failures in one system can quickly propagate across others, leading to widespread disruptions. 1. For example, competing algorithms digesting similar market data may collectively amplify systemic hazards during periods of stress. 2. Regulatory concerns. Need for clear regulations on AI in finance. 1. The rapid adoption of AI in finance has outpaced regulatory frameworks, creating gaps in oversight. 1. Regulators such as the SEC have emphasized the need for transparency and accountability in AI-driven systems to mitigate risks like herding behavior and market manipulation. 2. Explainable AI, XAI, is a proposed solution that requires firms to disclose the logic behind their algorithms, ensuring that decisions can be audited and understood by regulators. Differences between EU and US approaches. 1. The EU's GDPR and AI Act focus on strict data privacy rules and ethical guidelines for AI deployment, emphasizing fairness and accountability. 1. In contrast, the US relies on sector-specific regulations like SEC guidelines that prioritize market stability and investor protection. Chapter 2. These differences impact global AI adoption. Stricter EU regulations may slow innovation but enhance consumer trust, while the US approach fosters rapid deployment at the risk of systemic vulnerabilities. Impact of regulations on development and adoption. 1. Regulatory measures can influence how firms develop and adopt AI technologies. 1. Striking a balance between fostering innovation and ensuring stability is critical. Overly stringent rules may stifle growth, while lax oversight could exacerbate systemic risks. 3. Ethical considerations. Exacerbation of inequalities in the financial system. 1. AI has the potential to widen inequalities by favoring large institutions that can afford advanced technologies while marginalizing smaller firms unable to compete. 1. For example, proprietary AI systems used by major hedge funds may dominate market returns while excluding smaller players from accessing similar capabilities. Ethical implications of AI-generated financial advice. 1. Robo-advisors powered by AI provide personalized financial advice but raise ethical concerns about accountability. 1. If these systems make biased or flawed recommendations due to poor training data or algorithmic errors, investors may suffer financial losses without recourse. AI-driven job displacement in finance. 1. Automation enabled by AI is transforming roles within the financial sector, displacing jobs such as traders and analysts while creating demand for specialists in AI development and management. 1. This shift has societal implications, requiring governments to invest in reskilling programs to ensure equitable workforce transitions. Conclusion: AI adoption in finance presents transformative opportunities, but also introduces significant challenges and risks. Systemic vulnerabilities like flash crashes and model drift. Cybersecurity threats such as adversarial attacks. Regulatory gaps that demand clear frameworks. Ethical concerns around inequality and accountability. And societal impacts like job displacement. Addressing these issues requires collaboration between regulators, industry leaders, and ethicists to create a balanced approach that fosters innovation while safeguarding market stability. Section 7. Future Trends. 1. Continued integration. The rise of Edge AI in financial applications. 1. Role and growth. Edge. AI is poised to revolutionize financial services by enabling faster, localized decision-making. 1. Unlike traditional cloud-based systems, Edge AI processes data closer to its source, reducing latency and enhancing efficiency. 1. This capability is particularly valuable for fraud detection, high-frequency trading, HFT, and personalized financial services. For example, Edge AI can instantly analyze transactional data to detect fraudulent activities in real time, minimizing financial losses. The global Edge AI market in financial services is projected to grow at a CAGR of 33%, reaching $322 billion by 2034. Applications and benefits. 1. Fraud detection. Real-time processing allows financial institutions to identify and mitigate suspicious activities immediately, improving compliance and reducing risks. 2. IoT integration. Smart ATMs and mobile POS systems powered by Edge AI enhance customer interactions by delivering personalized services at the point of engagement. Regulatory considerations for Edge AI. 1. The decentralized nature of Edge AI presents unique regulatory challenges, particularly concerning data privacy and security. 1. Regulators must ensure that sensitive financial data processed on Edge devices complies with laws like GDPR in the EU or CCPA in the US. 1. Additionally, standards for securing Edge devices against cyber attacks are critical to prevent breaches that could compromise financial systems. The potential of quantum AI. 1. Quantum AI combines quantum computing with artificial intelligence to solve complex problems that are beyond the capabilities of classical computing. 1. In finance, this technology has the potential to revolutionize portfolio optimization, derivatives pricing, and risk management by processing vast datasets exponentially faster than traditional methods. For instance, quantum algorithms can simulate thousands of market scenarios in seconds, helping firms better prepare for extreme events like economic downturns or geopolitical crises. Companies like IBM and Google are actively exploring quantum computing applications in finance, with early-stage pilots showing promising results. Challenges and regulatory oversight for quantum AI. 1. Quantum AI introduces significant regulatory challenges due to its complexity and potential risks. 1. Key issues include transparency and explainability. Quantum algorithms often function as black boxes, making it difficult for regulators to audit or validate their decisions. Developing explainable quantum models will be critical for compliance. There's market fairness. The speed advantages of quantum systems could lead to concerns about front-running or market manipulation. Regulators may need to implement safeguards to ensure fair competition. 2. Investor strategies. Developing AI literacy among investors. To effectively navigate an increasingly AI-driven financial landscape, investors must develop foundational knowledge of AI technologies and their implications. 1. Understanding basic AI concepts. Investors should familiarize themselves with terms like machine learning, neural networks, and predictive analytics to better understand how these technologies influence market trends. 2. Evaluating AI-driven investment tools. Tools such as robo-advisors or sentiment analysis platforms must be scrutinized for their accuracy, transparency, and reliability. 2. For instance, investors should assess whether a robo-advisor's recommendation align with their risk tolerance and long-term goals. 3. Recognizing potential biases in AI models. Investors must be aware of biases introduced by flawed training data or algorithmic errors that could skew predictions or recommendations. AI-powered ESG investing. Environmental, social, and governance (ESG). Investing is increasingly benefiting from AI-driven insights that analyze vast datasets for sustainable investment opportunities. Machine learning algorithms can identify companies with strong ESG performance metrics by analyzing unstructured data, such as news articles or corporate reports. Predictive analytics helps investors anticipate long-term sustainability trends while avoiding greenwashing practices. Financial inclusion through AI. 1. Beyond ESG investing, AI has the potential to significantly enhance financial inclusion by providing underserved populations with access to credit and banking services. For example, machine learning models can assess creditworthiness for individuals without traditional credit histories by analyzing alternative data sources like utility payments or mobile phone usage patterns. The speed of evolution. 1. Both edge AI and quantum AI are advancing at an unprecedented pace, outstripping existing regulatory frameworks and creating challenges for policymakers. 1. The rapid evolution of these technologies requires dynamic governance models that can adapt quickly while fostering innovation. Conclusion. The future of finance lies in the continued integration of transformative technologies like edge AI and quantum AI. These innovations promise faster decision-making, enhanced fraud prevention, improved risk management, and greater financial inclusion, but come with challenges such as regulatory oversight gaps, cybersecurity risks, and ethical considerations. Investors must develop AI literacy while leveraging tools like ESG analytics to capitalize on these advancements responsibly. As these technologies evolve rapidly, collaboration between regulators, industry leaders, and technologists will be essential to balance innovation with stability in the global financial system. Conclusion. 1. Summary: artificial intelligence, AI, has emerged as a transformative force in the stock market and broader financial ecosystem, driving innovation and efficiency across industries. From enhancing trading strategies and optimizing supply chains to revolutionizing healthcare diagnostics and renewable energy, AI's potential to reshape the financial landscape is immense. However, this transformation is not without risks. Challenges such as algorithmic bias, cybersecurity vulnerabilities, systemic instability, and ethical concerns underscore the need for responsible AI development and deployment. While AI offers unparalleled opportunities for growth and innovation, its adoption must be guided by robust governance frameworks to mitigate risks and ensure equitable benefits. 2. Balanced perspective. A cautious yet optimistic approach to AI in the stock market is essential. On one hand, AI-driven tools like sentiment analysis, predictive analytics, and robo-advisors empower investors with data-driven insights, enabling more informed decision-making. On the other hand, the potential for over-reliance on AI systems, speculative bubbles, and unintended consequences necessitates critical thinking and due diligence. Investors must balance the use of AI tools with a deep understanding of their limitations and inherent biases. Similarly, regulators and industry leaders must collaborate to create an environment where innovation thrives while safeguarding market stability and investor trust. 3. Call to action. To navigate the rapidly evolving AI landscape, stakeholders must prioritize the following actions. 1. Ongoing research and education. Investors, policymakers, and financial professionals must invest in continuous learning to stay abreast of AI advancements. 1. Understanding basic AI concepts, evaluating AI-driven tools, and recognizing potential biases are critical skills for navigating the AI-driven financial ecosystem. 2. Responsible AI development. Financial institutions and technology providers must prioritize transparency, accountability, and ethical considerations in AI deployment. 2. Explainable AI, XAI frameworks can help build trust and ensure compliance with regulatory standards. 3. Global regulatory collaboration. Given the interconnected nature of financial markets, regulators and industry leaders must work together on a global scale to harmonize standards, share best practices, and address cross-border challenges. 3. Initiatives like the EU's AI Act and SEC guidelines in the US should serve as models for international cooperation. 4. Staying informed. The rapid pace of AI evolution demands vigilance. 4. Stakeholders must actively monitor technological developments regulatory changes, and market trends to make informed decisions and adapt to new realities. Final thoughts. AI represents a paradigm shift in the stock market and financial services, offering unprecedented opportunities for growth, efficiency, and inclusion. Its potential to enhance financial inclusion by providing underserved populations with access to credit and banking services underscores its transformative impact on society. However, this potential must be harnessed responsibly, with a focus on mitigating risks and ensuring equitable outcomes. By adopting a balanced perspective, fostering global collaboration, and committing to ongoing education, stakeholders can unlock the full potential of AI while safeguarding the integrity and stability of the financial system. The future of finance is undeniably shaped by AI. Embracing it wisely will determine its success.